Hey guys, welcome back to the channel. Today we are looking at a new SPAC ETF. Now, if you've been around the financial community, you've probably been hearing this buzzword SPAC this, SPAC that, and all this madness, right? It's kind of like the new hot thing, right? Well, on the ETF channel here, we look at ETFs. So recently, they put out a new ETF that is revolved around these new SPAC companies. So what we're going to do is we're going to dig in and figure out, it's going to be real surface level here, what a SPAC is, and then we'll look at the ETF. There's not a whole lot of information on it because it was just released a few days ago. Hopefully this gives you a basic understanding of what a SPAC is and how it works. And yeah, we'll get into it. So if you're new here, please like, share, subscribe, do all that good stuff. In the pinned comment down below is a link to my Amazon link. If you're going to do any kind of shopping, you want to support this channel, use that link. After you click that link, you can go on to Amazon, buy anything you want at no extra cost to you, and Amazon will send me a small commission on qualified purchases. Also down there is my Teespring link. Go check that out. Shoot me some feedback, anything you want to see. I've designed everything on there, so it'd be great to hear from you on that. So we'll just get right into it today. And what we're going to first discuss is what is a SPAC? Well, it stands for Special Purpose Acquisition Company. So this is how it works. We're going to break it down, then I'm going to show you a visual. So the founders, a special purpose acquisition company is formed by experienced business executives who are confident that their reputation and experience will help them identify a profitable company to acquire. Since the SPAC is only a shell company, the founders become the selling point when sourcing funds from investors. So let's say if Warren Buffett, let's just take Warren Buffett. If he wanted to acquire a company, well, that's probably a bad example because he would just go buy it. But he can form this special acquisition company, and investors can invest in that company while he goes out and tries to acquire a private company. That's how it works. So the founders provide the starting capital for the company, and they stand to benefit from a sizable stake in the acquired company. The founders often hold an interest in a specific industry when starting a special purpose acquisition company. So when issuing the IPO, the management team of the Special Purpose Acquisition Company, or SPAC, contracts an investment bank to handle the IPO. The investment bank and the management team of the company agree on a fee to be charged for the service, usually about 10% of the IPO proceeds. The securities sold during an IPO are offered at a unit price which represents one or more shares of common stock. The prospectus of the SPAC mainly focuses on the sponsors or the founders and less on company history and revenues, since the SPAC lacks performance history or revenue reports. All proceeds from the IPO are held in a trust account until a private company is identified as an acquisition target. So after the SPAC has raised the required capital through an IPO, the management team has 18 to 24 months to identify a target and complete the acquisition. The period may vary depending on the company and industry. The fair market value of the target company must be 80% or more of the SPAC's trust assets. Once acquired, the founders will profit from their stake in the new company, usually 20% of the common stock, while the investors receive an equity interest according to their capital contribution. In the event that the predetermined period lapses before an acquisition is completed, that 18 to 24 months, the SPAC is dissolved and the IPO proceeds held in the trust account are returned to the investors. When running the SPAC, the management team is not allowed to collect salaries until the deal is completed. So to put that in a picture, this one here on NASDAQ is pretty simple and straightforward. So it's a listed SPAC. So it's just a blank company. There's no it's just a holding company so that they can go raise money and find a privately held company to acquire and merge. So the listed SPAC is cash held in a trust. It's a blind pool of cash raised by a financial sponsor through IPO to acquire a private operating company, usually within 24 months. So what they do is they go and find a target operating company. They try to find a company that's not publicly traded, that has potential to disrupt industry most likely, and they want to take it public. So once they find that company and they convince them that they should merge with the SPAC, then they eventually become a successor company or a publicly listed operating company. And the value generation through highly incentivized management structure. So usually whoever this guy was, this company is enamored by them. They think they can run it better, so they become publicly listed. They merge, and then the SPAC essentially goes away, takes over the ticker symbol, or what would be the ticker symbol of the new operating company, and life goes on, and stonks always go up, right? In a perfect world, that is true. So with that, there's been a lot of SPACs that's come online, and without really digging into a lot of research, it's hard to pick 1-2 SPACs to go and just invest in, right? So that's where this ETF comes in. So this ETF by DefianceETFs.com, or Defiance ETFs, this website is DefianceETFs.com, came out with an ETF, SPAC. That's ticker symbol SPAK. So what is it? We're not gonna go through this part. It's just gonna go through everything that I pretty much discussed, but we'll go through right here. Why choose the Defiance SPAC ETF? So why you would choose any ETF. Picking the winners of individual SPACs can be very difficult. However, the ETF structure allows investors to access the most liquid SPAC IPOs in a diversified basket. SPAC allows both financial advisors and retail investors to participate in an IPO private equity style of investing, which is usually only available to large financial institutions. The ETF currently has 36 holdings, rebalanced on a quarterly basis. An 80% weighting is applied to IPO companies derived from SPACs, and 20% is allocated to common stock of newly listed SPACs. So 80% is weighting is going towards the companies that have already become that have already merged with the SPAC and have become publicly traded companies. The other 20% are shell companies that they're investing in that have not found a company to merge with quite yet, or they're in the process. Newly IPO companies derived from SPACs will be screened monthly and SPACs quarterly. So my thought is this ETF will have a high turnover rate. We don't have any of that information that I normally share about ETFs. So let's see. The Index SPAC and NextGen IPO Index is a passive rules-based index that tracks the performance of the common stock of the SPACs, warrants, and IPOs derived from acquisition companies over the preceding 36 months. We'll look at here. Net assets as of October 2nd is $11.18 million. The net asset value so far $26.30. Shares outstanding 425,000. Fund inception date of September 30th, 2020. Ticker symbol SPAK. The expense ratio, pretty cheap in my opinion for a specialty ETF of 0.45%, and it's holding 36 holdings. And we'll look at the top 10s here. They have a distribution schedule. We'll look at that real quick. I don't know why they have a distribution schedule. Maybe capital gains, maybe, but I doubt any of these will be paying any kind of dividends. So I don't know why they even have that. We'll look at the top 10 as of, I think it's October 6th is, yeah, data as of October 6th. So you have 19.39% in DraftKings. So that's already a company that has gone through the SPAC and has become a public company. 12.91% in Clarivate. Some of these companies you'll have to do some research on. 9.1% in Vertiv Holdings. 5.52% in Vivint Smart Home. I've heard of that one. 5.13% in Open Lending. 4.4% in Broadmark Realty Capital. I've heard of that one. It's almost like a REIT, I think. 4.12% in Immunovant. Man. 4% in Virgin Galactic Holdings. That's that space company. 2.69% in Repay Holdings, and 2.54% in Churchill Capital, which is ticker symbol CCXX, which I have a very small position in. And they're going to be merging here on the 7th, October 7th, I believe. So there's not much more I can tell you on this. You know, if you're into SPAC, if you want to, take part in this SPAC craze, but you don't want to do a boatload of research on the companies that these SPACs are trying to acquire, which a lot of times they're hard to find information about because they're not publicly traded. They're private companies that they're trying to acquire. So it's very hard to find investment cases or investment research on them, right? So the SPAC, the SPAK ETF, could give you exposure to that, and it'll probably be a pretty high growth ETF for quite a while. I would not personally put a big stake in it, but you want to put a few percent of your portfolio in something like this, I think that would be fine. I'm not going to personally. I have that SPAC CCXX, and I'll just hold on to those through merger and see how it works. I only got a small position, like 30 shares or something like that. So this doesn't excite me, but if you want to follow momentum, you want to follow the trends of the market, this may be something that you could definitely look into. So I'll leave links down below of this website. You can do a little bit more research. Please like, share, subscribe, do all that good stuff. Use those Amazon links and everything else down in the description below. You guys have a great week, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.